the question I received most frequently is straightforward. Is now the right time to invest in gold? And do you think the price is going to go up by the end of 2026?
So I have no idea what will happen to the price by the end of 26. What do I think in terms of your allocation? You should be holding an allocation to gold in your portfolio, right? How much gold should you hold in your portfolio? It's somewhere between 2 and 10% according to the literature, right?
Somewhere this 5%, yeah.
Yeah, so let's call it, exactly, let's call it 5 as kind of a round number. The best advice to any normal investor for anything like this is you dollar cost average. You buy a certain amount of gold every month or every quarter or every year, however often you do it.
Coming back to the question on ETFs. So if we talk about the portfolio construction perspective, should ETFs be viewed primarily as a strategic allocation or tactical instrument responding to this momentum?
The more ETF holdings there are, the more financialized gold becomes and the easier it is for the price to crash.
Now we go to the central bank part, because that's another significant development. If you see, since 2023 has been sustained central bank gold purchases. My questions to you is like, how should we interpret continued central bank demand in 2026?
What happened in 2023, I think that you talked about it, and I think you wrote about it as well. The huge change was that central banks suddenly began buying a large amount of gold. So central banks had gone from net sellers to net buyers.
Hello everyone, this is Dr. Hafiz Muhammad Usman Rana, and welcome to the Dr. Rana Brief, where we examine global political economy, financial markets, and monetary trends shaping the world. In 2023, interest rates were at multi-decade high. Real yields were positive. Traditional financial models suggested gold should weaken, yet gold remained resilient. And now in 2026, you have seen rates are softer, sovereign debt levels are higher, fiscal pressures persist, central banks continue accumulating gold, and ETFs are again attracting global inflows. So the central question today is this: is gold reacting interest rate cycles or signaling something deeper about confidence in the global monetary system? So today I'm joined by Dr. Fergal O'Connor, Senior Lecturer in Financial Economics at University College Cork, and he's a recognized authority on precious metals markets. He acts as an expert advisor to the World Gold Council and London Bullion Market Association. We have collaborated on research examining the macroeconomic drivers of gold. So I look forward to continuing that dialogue today. So welcome to the Dr. Rana Brief, Dr. Fergal.
Thank you very much for having me.
In 2023, if you see, the dominant narrative was straightforward. Higher policy rate increased the opportunity cost of holding gold. Yet, despite tight monetary policy, gold did not collapse. In my recent writing, I also suggested that markets may have underestimated deeper structural pressures, including fiscal expansion, sovereign debt sustainability concerns, and long-term monetary credibility. So, Fergal, I just wanted to ask you, do you think that 2023 exposed limitation in the traditional rate versus gold framework, or were investors overly focused on nominal policy rates rather than broader systematic risk?
Yeah, like between 2007 and 2023, you had a really tight relationship between real US dollar rates and the gold price. If you inverted one, the two lines would go along almost perfectly together. 2023, they just moved completely apart. There's a complete breakdown in that relationship. Surprised a lot of people. But if you look at the relationship before 2007, it didn't exist in the same way. There was nowhere near as tight. So it wasn't that something entirely new happened. It's that things kind of reverted back to the regime that was there before the global financial crisis, because the global financial crisis changed everything for gold, right? So that was the point where gold came back into vogue. The early 2000s, gold prices were $250, right? We're now sitting over 5,000-ish. And gold was dead. Nobody cared about it. It didn't get written about in the newspapers. There was very little analysis being done on it. from the global financial crisis up until 2013, gold came back into vogue. Banks were writing huge amounts of research on it, and it became a much more financialized asset, right? So ETF, the market went through huge changes in that period. There were no gold ETFs prior to about 2003. The Chinese gold market only really opened up in 2002. So there was a period in there where gold was completely changing up until the global financial crisis. It was getting easier to buy, both for a huge new population, right, in China, and for retail investors. They were suddenly able to buy gold through ETFs that was really, really cheap. What happened in 2023, I think that you've talked about it, and I think you wrote about it as well. The huge change was that central banks suddenly began buying a large amount of gold. So central banks had gone from net sellers to net buyers somewhere around 2010. So it wasn't entirely new. They had been buying gold. They had been building up their gold stocks. But from around that period on, they suddenly started buying about 1,000 tons of gold a year, which is an enormous amount. Total global mine supply each year is about 3,200 tons, right? So of all the new gold coming into the market, 1,000 tons of that was being bought up by central banks, and they don't sell very much of it. A lot of those were, I think, what you've mentioned. There's kind of fears about the dollar, fears about sanctions are another big issue. So fears that your dollar assets will be sanctioned. But it isn't just, it's not just Russia buying gold, and China have been buying gold for a long time. Everyone's been buying gold. Poland, the Polish central bank, has been a massive buyer of gold, right? It's not in the euro system, but it's very close to it, and it's still been buying a lot of gold and talks about buying gold. Even tiny little central banks like the Irish central bank doubled their gold holdings during the period. So the huge difference, and I think the reason for that 2023 kind of split, where suddenly gold and real rates stopped dealing with each other, was that a new buyer entered the market in a big way, and that was central banks. And that reveals something. Sorry, one last little bit. I know I've been rambling. It reveals something about gold which is quite different to other assets. Gold has a really heterogeneous set of buyers, right? You've got investors who are big investors. You've got central banks. You've got small investors. But outside of kind of traditional financial institutions, most gold is owned as jewelry. So about over half of all the gold that's ever been mined, gold doesn't go anywhere. It doesn't get used up. Over half of all the gold that's ever been mined is owned as jewelry. So most buyers are consumers. So gold has quite a complex structure in terms of its demand. When prices collapsed in the early 2010s, jewelry stepped in. Gold looked cheaper, and jewelry buyers started buying more. Whereas if you look at the opposite, if you look at the really high prices, the end of 25, beginning of 26, it looks like jewelry buyers are stepping away now because it's expensive, and financial buyers are the ones that come in. So it kind of exposes that thinking about gold as a purely financial asset is incorrect. It's a financial asset, but it's also a monetary asset for central banks. And finally, it's a consumer good. It's a consumer asset. I know that people are buying gold jewelry as an investment, but they're not selling it in the same way that you would be selling an ETF, for instance.
Yeah, absolutely. So if we see, like you mentioned, central bank, they started buying gold. We'll talk about this one in later. But if we move forward, and if we talk about now, rates are lower than in 2023. However, the global debt, if you see, global debt to GDP ratios remain elevated. Fiscal consolidations appears limited in many advanced economies, as you mentioned. And geopolitical fragmentation persists. So if gold, you see, showed resilience under the tight policy and strength, like under easing conditions, so does that suggest that we are witnessing a structural re-rating rather than a simple cyclical like response? Or is gold today acting less as a reactionary asset and more as a barometer of monetary credibility?
So I think a lot of it, definitely up until the later half of 2025, was monetary credibility. So there was worries about who would be appointed as the next governor of the Federal Reserve, whether they would continue to act independently and target inflation. I think the thing to see, the prices, the quarterly returns for gold. I'm just going to check the numbers precisely now so I don't lie to you. The quarterly returns for gold last year were unbelievable. They were unbelievably high. If I can just pull up the sheet, which doesn't seem to want to come up here on my computer. Over the year, gold prices were up 60%. But even looking quarter to quarter, they were going up at rates that really are very difficult to understand unless you see that it did enter kind of a bubble phase, right? There was a lot of fear, right? There's a lot of uncertainty, especially coming out of the United States. But that fear then I think turned into a bubble. The way prices were rising, it took it took a very long time to get to $5,000, but it took 3 days to get from $5,000 to 5,500. The gold prices and silver prices attached to that too. Silver is kind of gold's slightly more volatile little brother. All of those markets got really frothy together, and I think it just became a really classical bull market where people became massively overextended. There's anecdotal evidence that there was a lot of borrowing in the market, because when the price started to fall, other assets also felt fall. So people looked like they were maybe selling other assets to cover loans that they'd taken out on gold, taking out leverage positions. So it's definitely, I think the long run, there's two drivers maybe for the very long run for the gold price. The first one is monetary. So every time there's a worry about the monetary system, gold gets a huge shot in the arm, like it did up until when the price peaked in 2011. The reason it peaked in 2011 is Draghi came forward with a statement that he would do whatever it took to save the euro. So that monetary fear disappeared and gold prices came down. Now, they didn't come down all the way back to where they were before. The monetary fear tends to send gold higher. Let's say it sends gold up an awful lot. Gold will fall, but it won't fall by the same amount. So it gets a boost from it. That's what seems to be happening in the current phase. So one long run driver is monetary debasement and monetary fear. But gold prices go up faster than inflation. So if you look at gold from about 1970, when gold prices become free, right, when the American government stops fixing them, all the way through to about 2025, average inflation is something like 5% off the top of my head. Average gold price rises are over 9%. So 9%. Gold has massively outstripped inflation over the period. So monetary worries are definitely part of what sends gold higher. But some research that I put out last year with the World Gold Council looked at it, and the very long run, so if you're looking at it over that 50-year period, the other main driver beyond kind of the financial aspect is just growth. Because again, in all these discussions, and maybe the reason that gold, like I'd be very positive about gold in the long run, the main reason I would be so positive is that a lot of the long run drivers of gold come from growth, from GDP growth, right? So from economies where gold is traditionally bought as not just an adornment, but as a monetary hedge, right? So if you go to countries, go to Asia, you get a huge amount of buying, and in the very long run, those economies don't look like they're slowing down their gold purchases. They go through peaks and troughs depending on whether the price is high or the price is low compared to the last year, maybe. But in general, there's a long run push there for higher gold prices from people wanting to buy something, which there's that old joke, why would you buy it? But because they're not making it anymore.
Yeah. Okay, so now we go to the central bank part, because that's another significant development. If you see, since 2023 has been sustained central bank gold purchases. So I'm just talking about a political economy perspective, and this appears strategic rather than tactical, potentially like reflecting diversification concerns and also shifts in reserve management philosophy. So my questions to you is like, how should we interpret continued central bank demand in 2026? One. Number two, what signal should private investors reasonably draw from this behavior? Whether we are going towards de-dollarization, that's we heard everywhere in Twitter, LinkedIn, people are talking about. So what are your thoughts on it?
So the main thought is that I think a lot of, especially emerging markets or developing countries, central banks were under allocated to gold, right? So they didn't have enough gold. The Chinese central bank has been buying up a lot of gold, but even at that, I think, I can't remember the exact number. I think that their percentage of gold reserves is only something like 3%, right? So they're massively under allocated to gold relative to other central banks. And it's hard to know exactly what the number is because you've bank, the American central bank in America, where they don't really have any other reserves at this point besides gold. But European central banks have also been increasing their gold allocations over the last few years. I can't remember his name is Jan on Twitter that I used to follow. He had a really good theory that they were looking to have a certain proportion of their GDP held as gold reserves because it was the only way he could explain why, how they were coming up with the numbers they were coming up with. So I think what investors can take from it is, there was a fear, or not even a fear, there was a belief that gold was no longer a monetary asset, probably in the early 2000s. So if you read what people were writing about it, even gold market participants, so if you look at Goldfield Mineral Services, they had a survey that they would do every year. That was where you would get the numbers on how much jewelry was bought in different countries, how much mining was happening. It was just the annual report on gold markets. They would have been talking about gold no longer really as a monetary asset. Like central banks, they had slowed down their sales, but they were still selling. Gold was over as a monetary asset. And what's changed, particularly since 2023, but probably started in 2010, is that it's become clear that gold will remain a monetary asset. It's not going anywhere. One of its major functions is going to stay as something central banks will own, and they don't tend to sell much gold, right? So they're not looking for they're obviously careful in their buying. They have traders working for them, so they're not paying any price going, but they're not really selling it normally, right? It's maybe they'll sell a small amount here and there for liquidity, but mostly the amount of gold they have is stacking up and stacking higher. And somewhere in the last 2 years, central banks have gotten back to the point where they own more gold than they did in 1970. So back when the gold sales started, the gold standard collapsed, and gold stocks and central banks started to go down in tonnage terms, right? So in terms of the number of tons they have of gold, that's reversed, and we're above the point. So they now own more gold than they did back when we had a gold standard. And when we had a gold standard, gold prices were $35 an ounce. They're now $5,000 an ounce. So you're talking about gold prices that are 15 times higher. So their assets are in dollar terms, 15 times higher than they were in 1970.
Okay, and we have also witnessed that most of the billionaires in states or UK or advanced economies, they are just buying physical gold bar and moving that one from uh, like their own country to Singapore. That's now a hot market nowadays. But coming back to the question on ETFs, which is like nowadays is a hot topic. Everyone is talking about gold ETFs, which have like again attracted significant global inflows. We can say that they offer liquidity, transparency, and accessibility to the investor. But ETFs are financial instruments and also embedded within the broader market infrastructure rather than direct physical bullion ownership. So, if we talk about the portfolio construction perspective, should ETFs be viewed primarily as a strategic allocation or tactical instrument responding to this momentum, which is right now? And does increased financialization amplify volatility in the gold prices? What do you think?
Yeah, there's actually, I know there's a really good paper by Bauer and McDermott, so who look at why is gold a safe haven, right? So one of the real reasons people love gold is that in market crashes, gold tends to hold its value, right? So there's a kind of a misconception that it goes up in value. It doesn't really in the day or two after a crash. It tends to go down the day of the crash because people are selling gold to get liquidity, and then it goes up again. But it tends to hold its value in the days after a crash. Bauer and McDermott have a nice discussion where they talk about the idea that the reason it works so well is it's not really that financial an asset, which I think goes to your point really nicely. The more ETF holdings there are, the more financialized gold becomes and the easier it is for the price to crash. because let's say gold in the 80s, the 90s, or even the early 2000s, for ordinary investors, they couldn't really panic sell gold that quickly in a way that would affect the price, because if they were holding gold, they were maybe owning jewelry or coins or bars. Maybe they were holding it with a vaulting company, but it was still a slower process to sell. It was like you couldn't just click a button and sell all your gold that easily. And even if you did, the bullion, if you sold all your gold jewelry, cash for gold type of thing, it would take a few days for that gold to actually reach someone where it would touch the price of gold on the London or the New York or today the Chinese market. Whereas obviously selling ETF gold is immediate, right? And in some ways, day to day, it's now the clearest signal of what ordinary investors, or at least more ordinary investors, feel about gold, because you can see it by the end of the day. You can see what the price is on them. You can also see whether they've been buying or selling pretty accurately within a day or two. Overall, I think it's still a good thing for gold because it's still quite small, right? So like last year was an incredible year for gold ETFs, and total purchases were about 800 tons, I think. Yeah, about 800 tons. The previous year was flat. They actually fell by about 2 tons, and they'd been selling a little bit before that. There's a couple of thousand tons held by ETFs, but when you put that in perspective, like central banks buy 1,000 tons every year. They have done for the last few years. So the amount of gold held in ETFs is small-ish. I think the gold market would be much weaker without it, because it's very expensive. Before the advent of ETFs, holding gold was quite an expensive thing to do. You either paid quite a bit in fees to a gold mutual fund or something like that. ETF charges are tiny because it costs. When you own it, the biggest problem with owning gold is it costs you money. It doesn't make you money. ETF fees are tiny, and since ETFs, the competition has meant now there are vaulting services like Bullion Vault in London, where the fees to hold your gold as bullion with them is pretty much the same or less than a lot of ETFs. Before that, if you wanted gold, you had to go out and buy a coin, which you paid a premium on, and then when you sold it, there was a premium on the other end too. So the price needed to move a huge amount before you can make money if you're buying gold coins to take home with you. And plus, then there's the risk that your gold coin will get stolen. Whereas with ETFs, if you're buying properly regulated ETF, you're a lot more secure. So there's definitely cost to it. It raises the risk that gold becomes a more financialized asset. But at this point, ETFs have been around a long time, right? We're kind of over 20 years into ETFs at this stage. They probably do contribute to volatility, right? So the big price falls that we saw a couple of weeks ago for 2025 when the price peaked, some of that is definitely down to ETF sales. But overall, I think it gives a lot more options to investors. And it isn't just small investors. Some really large companies are using ETFs, really large investment companies are using ETFs because it's a regulated product, so you can buy it more easily.
Yeah, so I think the question I received most frequently, straightforward, is now the right time to invest in gold? And I, rather than discussing the price targets, I prefer framing the issue around portfolio allocation, risk management, and long-term strategy hedging. So from a financial economics perspective, I just wanted to ask, should gold be timed or held consistently as protection against fiscal and monetary instability? So what developments would materially weaken the case for holding gold? And do you think the price is going to go up by the end of 2026?
So I have no idea what will happen to the price by the end of 26, right? And like like all these podcasts, none of this is financial advice anyway. What do I think in terms of your allocation? You should be holding an allocation to gold in your portfolio, right? How much gold should you hold in your portfolio? There's no easy answer to that. It's somewhere between 2 and 10%, according to the literature, right?
Literacy, yeah.
So
Somewhere
let's
this
say
5%, yeah.
Yeah, so let's call it exactly. Let's call it 5 as kind of a round number. The thing is that if everybody allocated, so global allocations to gold are about 2%. So 2% of all assets in the world are gold, right? So if you were allocating 5%, you would be allocating more than most people to the gold price. The question then is, do you time it? What do you do? I don't know. I mean, all the research says that people cannot time the market, right? And if you look at a chart of the gold price in 2010, 11, 12, 13, you'll see frequent peaks followed by massive falls with another peak followed by another. So timing at what point along that cycle should you have been buying gold, you were never going to know, right? And I think the price bottomed out at about $1,100 an ounce. There was nothing at that. There was no news story at that point that caused prices to suddenly kind of stop falling. They kind of went sideways for a long time, and then they went up. So timing gold purchases seems impossible. Like, the best advice to any normal investor for anything like this is you dollar cost average. You buy a certain amount of gold every month or every quarter or every year, however often you do it, and you just put a certain amount into it, and then the hope is that over time the price rises, right? So even then, if you end up buying it, let's say 5,500 was the peak, right? And let's say we're still at really high prices. You're only buying a small amount of gold at that high price, right? And then you're also, unfortunately, probably only buying a small amount of gold when it hits the bottom, when it reaches its low price. But that means that over time you're getting the average price, and then hopefully, if gold is a good investment, gold prices go up over time. So on average, you make money on your gold purchases. But gold is a long run investment. It goes through long periods of down and sideways. You've got a half-life for shocks of about 5 years, really. So if you're investing for less than 5 years, you could easily lose money on gold, right? That's kind of the reality in terms of it. So if you're buying gold, you're buying it as almost like as a pension product, right? You're putting it away. If you're buying it to make quick bucks, good luck. It's definitely not something I think me or you are able to kind of give people advice on. So I think it's really boring, right? Investment advice is really boring. You buy a small amount of everything all the time. But I'd be positive on gold in the long run, and the reason the positive in the long run is you have a trend of central banks buying again. But on top of that, you have economic growth coming from from Asia, where gold demand is still strong, right? There's still a cultural demand for gold. There's very little cultural demand for weddings and all this, exactly. So to me, there's, if economic growth, gold production is about 1.5% a year. Economic growth, real economic growth, maybe 2%, 3% a year. That means that economic growth is always outstripping new mine supply. It's not definite, but if people's tastes stay the same and they continue to buy gold in the way they do now culturally, then you would expect that the demand for gold will remain for prices to go up. And another weird fact is, if you look back at the gold bull markets we've had in the past, gold bull markets in the past have been between 400 and 800%. We're currently at about 450%. So we're somewhere in the lower range of what a bull market has been historically, but we're nowhere near the top end. So there's certainly a possibility that gold goes higher from where it is now. But regardless of that, at some point it's going to fall. So let's imagine this uncertainty continues, monetary uncertainty, political uncertainty, war. At some point, hopefully, that is going to dissipate, right? We really don't want this to continue forever. And when it does, gold typically drops 30 to 40%, just like it did after 2011.
Yeah.
So if it's not at the top now, if it goes higher, probably means the fall is going to be a little bit more painful when it does happen. So another point to consider.
Yeah. So the key message is, don't put all eggs in one basket. So you have to diversify your portfolio. If gold remained resilient during high rates in 2023 and strengthen as rates eased in 2026, so perhaps it's not merely reacting to policy, but evaluating confidence in the global monetary order. So thank you so much, Dr. Fergal, joining today. Really appreciate it, and looking forward to continue this dialogue in the future podcast. Thank you so much.
Thank you very much for having me.